Muted.
I started in this business back in the late 1980s, and we really have come full circle now on plan fees. And that's why the name Back to the Future kind of came to me. I think that movie came out in about 1985 or 1987, about the time I started in this business. So if you remember back then, the 401k marketplace was completely different than we have today. Back in the early 90s or late 80s, companies that had 401k plans, they were really simple. It was unusual to see plans that had maybe more than 10 funds on the menu. Typical was 4 to 6 funds. There was, daily valuation was still something that was very rare, if ever implemented. People got a statement on their account, maybe every quarter. Sometimes 4 to 6 weeks after the end of the quarter. They could move money between their funds, maybe once a quarter if they had a really state-of-the-art system at the time, and really limited services, the basic record-keeping services. But the fee situation was completely different as well. Typically a company would engage with a third-party administrator, whether that would be embedded inside a mutual fund company or on a standalone basis that would keep track of the participant accounts, pay them a hard dollar fee. Oftentimes the plan sponsor paid that fee. Sometimes the fee was deducted, on a hard dollar basis from participant accounts each quarter. But really basic. Marketplace changed, of course, and the advent of mutual fund revenue sharing came along sometime, in the early 1990s, and it really came along with the advent of daily valuation record-keeping systems. So essentially, the record keepers, through technology advancements, really took the place of a traditional mutual fund platform. Instead of quarterly evaluations, participants were able to view their accounts on a daily basis. Websites grew up. Multi-fund or open architecture platforms proliferated. Really, the record-keeping industry really turned from kind of old traditional balance forward to really replacing the mutual fund company services, but at the plan sponsor or plan level. With that, the record keepers quickly figured out that they were fulfilling much of the role that the traditional mutual fund was fulfilling for its shareholders, such as valuing accounts on a daily basis, posting dividends, providing information like annual reports and prospectuses to participants in the plan, doing transactions, really the traditional role of the mutual fund transfer agent. And within the mutual fund, of course, people that were invested in funds were paying for that service. So the record keepers entered into what we call today revenue sharing agreements with the mutual fund, with the idea that they were taking over those services on behalf of the fund shareholders and should get compensated for that. Well, progress continued, and where the first revenue sharing agreements were kind of one size fits all, shortly after that you had this huge proliferation of different share classes offered to different size retirement plans. So lots of iterations of this, from R shares to K shares to institutional shares to service class shares, you name it. A whole alphabet soup of different revenue sharing agreements pegged to a specific share class came into being and still exists today. So it really got much more complicated. And it really led to what I'll call the free retirement plan administration paradigm, where you started back in the late 80s, early 90s, where there's an explicit fee for record keeping and servicing participants, where all those fees got embedded through the mutual fund expense ratio and in various share classes. And at the end of the day, plan sponsors and plan participants came to believe that their 401k was free because there was no kind of on-the-page fee being deducted from their account. Well, that was all fine for a while until the plaintiff attorneys got a hold of this, and lawsuits really started to proliferate. Because of the opaqueness of that kind of free retirement plan, the shift from companies paying fees to embedding those fees into the mutual fund expense ratios through share classes, the lawsuits really started to happen around the mid-2000s. So whether it was ABB case, the Walmart case, Edison versus Tibble, and really today I would call it almost an avalanche of fee cases coming out almost on a daily basis out there in the marketplace, really challenging this whole notion of free retirement plan administration. So it really led plan sponsors to really reevaluate, how much are they paying for their services, who's paying it, and making sure that that's fair. Well, the government got involved as well. Kind of coincident with the lawsuit, they issued regulations under 404A5 that requires plan sponsors to better disclose these embedded fees that participants are paying to manage their own 401k plans. 4AB2 disclosures that require service providers to give plan sponsors more information so they can make better determinations about their fee structure with their plan as well. Then, of course, last month, the new conflict of interest rule that the DOL issued is really changing the marketplace once again. And while we don't know all the ins and outs of that rule, almost 1,000 pages when you try to get through it all, it's really driving us again full circle from where we started back in the early or the late 1980s, early 1990s, where it was pretty easy to figure out what you were paying and who was paying for the 401k plan, to a more opaque system. But now through regulation and through the courts, it's really opening up again. So the new iteration, while we're not quite back to where we started, and it's really the movement has already started in the large plan market, is something that we call fee levelization, which is really another name for making sure that we know what we're paying for record keeping services, that component is competitive, it's disclosed, and it's transparent to avoid a lot of the traps that the marketplace essentially created through this evolution of revenue sharing payments among service providers. So with that kind of as background, what does ERISA or the DOL say about this? Is really the purpose of today's conversation is to talk about the fair allocation of these fees and how to address the evolution of how plans are paying for fees in the marketplace. Well, kind of the defining notice is 2003-3 Field Assistance Bulletin that was put out by the DOL. And essentially it says ERISA has no provision specifically addressing how plan expenses may be allocated among participants and beneficiaries. So again, there's nothing really embedded in the law that at least we can see that gives a roadmap to plan sponsors about how to proceed. However, you read the next part of the paragraph here, and it says unless your plan document has a specific method, it's a fiduciary act that the plan fiduciary must undergo a prudent process to select a method. There's no right or wrong way to do it, but you need to definitely demonstrate that you thought about this, you went through a prudent process, you made sure it was fair or made a determination that it was fair, and you've implemented that. And of course, like all prudent processes, it's not a one-time deal. As we kind of demonstrated through the evolution of plan pricing, the marketplace is continually changing. So it's something a plan sponsor really needs to think about putting in place and making sure that they're up to speed with it on an ongoing basis. So with that, what I wanted to cover today is to delve into this whole issue by, first of all, kind of recapping with the introduction to investment and record-keeping fees, kind of how do we take apart an expense ratio of a mutual fund and make some of these determinations. 2, get into allocation methods being used in plans today. What is levelized fee allocation versus unlevelized fee allocation and the ins and outs of that. And then 3, what's it take to implement a levelized pricing solution with your client. So with that, let me go ahead and start with topic number 1, kind of a recap of record-keeping fees kind of as they stand today. So this slide 6 on the left there, is a typical structure. Think of that circle as a mutual fund. And in that, you really have 2 levels of fees being charged to that mutual fund through what we call the expense ratio. I think we're all familiar with that term. So you have investment management for fund management fees. They're paid to the investment manager of the fund to not only manage the assets, but kind of administer the fund at the highest level. And then you have everything else that we typically today call revenue sharing. These are 12B1 fees, shareholder servicing fees, sub-transfer agency fees. These are only some of the names for these types of fees that we see in the marketplace. These are not legal names, so depending on the fund a particular plan owns, they may be deemed something different than what we're showing here. But essentially, that's the variable part of a mutual fund expense ratio. Given multi-fund share classes, what happens is that portion of the fund's expense ratio either collapses or gets bigger depending on the share class you're using. So you may have a mutual fund expense ratio that has no revenue sharing in it, and all you're left with is investment management fees, or a typical structure like we see here today. The last piece of this diagram really is the circle around it, that if for some reason the amount of revenue sharing that the record keeper is receiving doesn't cover their services, they may also wrap the mutual fund with an additional level of fees. So kind of breaking that down, what you really need to do is understand, and really at a fund-by-fund level, is to begin to separate the total expense ratio by these two major components. So again, recapping again, investment fund management fees are at the top. They tend not to vary with the different share classes. They tend to be static. What you're left with is how much revenue sharing is left in the fund to offset record-keeping fees or being paid out to a third party that you want to recognize. And that would equal, of course, the total expense ratio for the fund, those two things added together. What we're going to focus on is the middle part here, the revenue sharing portion of a mutual fund expense ratio, and then how that delves into the proper allocation of fees among participants, and then how fee levelizing can help solve some of the issues that come out of understanding that. So putting that all together, if you look at our little diagram at the bottom of page 8, you see an example of Fund A with an operating expense ratio of 1% total. And a typical split is, 65% of it goes to the investment manager to manage the fund, and then the rest is revenue sharing at 35 basis points. Now, it would be great in a perfect world if every single fund and every single 401k plan had this exact sharing of investment management fees and revenue sharing. But as you know, working with your clients and looking at their fund menus, the revenue sharing component of this can be all over the place. It could be 0 in some cases. It could be 100 basis points in others. So you really have to understand how this is split up among the two. So with that, I think we've kind of covered the basics of mutual fund expense ratios, revenue sharing versus investment management fees, and the importance of understanding how to split those two things up. But I think we're right in time for our first poll question.
Hi all, so we're going to take a brief pause for 30 seconds. I'm going to launch a poll right now. So the first question is, the term revenue sharing refers to payment made by investment vehicles record keepers making payments to plan participants, plan sponsors, sharing profits with plan participants. I want to give 30 seconds for everybody to respond to the poll, and we'll resume. We're going to close the poll, and Chris, it's back to you.
Great, Chad. Thank you. So for the next part of the presentation, I really want to get into some really concrete examples of how revenue sharing works at the participant level, some of the problems that arises from that, and how we can solve many of those things through levelizing fees. So for that, the examples I'm going to go through over the next couple of pages have these assumptions built into them. Let's say we're trying to simplify it. Let's say we've got a plan that's administered by ABC Record Keeper. The revenue requirement, or the fee that that record keeper needs to run the plan for the services that were negotiated for, is 5 basis points. They don't really care how they get paid that, but they're going to earn 5 basis points to record keep the plan. And let's assume, for this purpose, we're using revenue sharing payments to finance that 5 basis points coming out of the fund. The plan has 3 participants, Jack, Jane, and Joe. They're all going to start with the same account balance of $100,000. They're each going to be in 3 different fund share classes. So one, they're going to invest in a fund that actually produces the same rate of return, but they have different revenue sharing amounts being built into their expense ratio to try to give a real good apples-to-apples comparison. So here's how typical plans look today without fee levelization being implemented. So we got Jack, Jane, and Joe. Jack's in Fund A, Jane's in Fund B, Joe's in Fund C. And again, we're just going to focus on the revenue sharing portion of this fund. So Fund A shares 35 basis points to the record keeper to offset record keeping fees. Fund B shares 5 basis points, and Fund C shares 0. Record keeper, again, going back to my example, requires 5 basis points. So the record keeper is going to retain 5 basis points to offset their fees. So when you look at that, it becomes clear that Jack, who's paying 35 basis points against the 5 revenue requirement, is paying a disproportionate larger amount of fees than Jane, who's paying the exact amount through the revenue sharing payments Jane's fund produces, and Joe is taking full advantage. He's in a fund that has 0 revenue sharing payments and is paying 0 towards the overall cost of the record keeping of the plan. So it's pretty clear that this is an uneven allocation of record keeping fees. Not uncommon though. If you look through most of your plans that haven't been through fee levelization or something like it, this is a very common example that's out there in the marketplace. So what would happen if you were to levelize fees? So the concept of fee levelization looks like this. So again, the same 3 participants, Jack, Jane, and Joe, same revenue sharing amounts, 35 for Jack, 5 for Jane, 0 for Joe. Same revenue requirement to the record keeper, but now we introduce something called an account credit or debit. So that's where, if I'm Jack, instead of paying my entire 35 basis points towards record keeping, I actually would see a credit being paid back to my account for the difference. So I end up paying exactly 5 because I get a credit back into my account of 30 basis points. Jane gets a 0 credit because revenue sharing equals the revenue requirement. Joe doesn't get to play the system any longer. So Joe does not get a free ride under fee levelization. So Joe ends up getting a debit to their account of 5 basis points. At the end of the day, that means all participants pay the same 5 basis points towards record keeping. The very simplest level, that's what fee levelization is. Let me take that to a dollars and cents example. So remember my example, Jack, Jane, and Joe started with $100,000. Their fund produced a 3% rate of return over this period that we're examining. So they've got a gross ending balance of $103,000 before we calculate the revenue sharing that the fund might throw off. So if you do that calculation, the total amount of revenue sharing based on that $103,000 or $100,000 beginning balance is $400 of revenue sharing for this small little plan as an example. Record keepers, revenue requirements 5 basis points, they only need $150 of that. So in a typical scenario today in a plan like this, where you have what we call excess revenue sharing, the difference between the $400 being generated and the $150 the record keeper needs to offset their expenses, that usually gets accounted for through what we call a para reallocation. So that excess revenue is often put into whether we call it an ERISA budget account, a plan expense account, or otherwise, named by the particular record keeper. The money goes into a plan account. The record keeper deducts their fee from that account, and then we have excess revenue. So, and then what happens typically at the end of each year, there's a reallocation of that excess revenue back to the participant on a pro rata basis. That's the most common way this is done today. So you can see that this further exacerbates the issue of unlevelized fee allocation. So look at our example. So Jack, who initially paid 35 basis points, or $350, gets a reallocation of the excess revenue, his portion of the excess revenue, which is $83.16, which is pro rata based on his account balance. So he still ends up paying $267 towards record keeping. Jane, who paid exactly the amount of required revenue, also gets a credit of $83.40 because everybody's treated the same way on a pro rata reallocation of excess revenue. So Jane actually gets more money in their account than they paid out in record keeping fees. And of course, Joe goes to town and gets the biggest reallocation because he gets a pro rata share of the total, even though he paid none into it. So it really distorts it. If you look at the ending balance as a result of that, Joe's ending balance would be $103,083, where Jack had $102,733. So Jack basically had a shift of assets from his account to the other two participants. Clearly, that could be an issue if examined. Now, to make things even more complicated, let's say Joe is a highly compensated employee, very sophisticated investor, and says, hey, if I just sit here in the zero rev share fund and everybody else is paying revenue sharing in their accounts, I sit back and get to collect part of their money when this reallocation occurs each quarter. You can obviously see the distortions that come up from the revenue sharing payments that are being made in plans today that are uneven. So how does this look in a levelized world? So let's take the same example that we had at the top of the page. Nothing's really changed so far, but now we're going to give a levelizing adjustment in dollars and cents to the participant. So Jack gets a $300 credit, Jane gets zero money back, and Joe gets a debit of $50. So rather than a pro rata reallocation of excess revenues, everybody actually gets back what they actually paid in less the revenue requirement. So everybody ends up paying the same dollar fee, $50 per, and they got the same exact ending account balance by participant. So it really does solve most of the major issues with fee levelization. Here's what this might look like at a plan level. So we just kind of examined 3 participants in a very isolated environment. This is a typical menu. Just kind of grabbed it off one of our clients. Nothing really special about it. You can see the funds listed here, the share classes, the amount of assets in each fund. Next, if we apply the expense ratios and the amount of revenue sharing coming off each fund, you can see the math. So for example, the Vanguard Institutional Fund, the second from the top, has an expense ratio of 4 basis points, and it shares no revenue to offset record-keeping expense. The fund right below it, American Funds Growth Fund of America R4, expense ratio of 68 basis points, but pays 35 basis points in revenue share. So you can see the range goes from 0 to 35 basis points, depending on the fund I might own as a participant. In this example, we use a 10 basis point rev requirement. There's excess revenue that's generated because the plan produces about 23 basis points in revenue, and the plan in this example, the record keeper deemed it only 10. So there would be a reallocation of that $178,000 or excess revenue back to the participants on a prorated basis. But again, still creating that uneven reallocation that we just talked about in the previous example. So how does this look with fee levelization? Well, here's how we would look on a fund-by-fund basis. So again, going back to the Vanguard institutional that paid no revenue sharing, that anybody in that fund would get a debit of 10 basis points. Anybody in the American Funds Growth Fund of America R4 would get a credit of 25, the difference between the rev requirement and the amount of revenue sharing initially paid in that fund. So with that, before we move on to marketplace levelized solutions, Chad, I think it's time for our next poll question.
Yep, correct. Anyway, so again, we're going to take a brief pause to do another question. I'm going to launch it now. Question, revenue sharing can create an uneven allocation of fees paid by plan participants. True or false? 30 seconds, and then we will resume. All right, all, thank you very much. The poll is closed, and we will resume now.
Great, thanks, Chad. So moving on to our third topic, implementing levelized solutions. I want to go over a couple things here. Obviously, if you follow my presentation so far, you can say, why wouldn't everybody be in a levelized pricing scenario? Given it solves most of the issues that we talked about today. Unfortunately, there's not necessarily a straight line from where you are today as a plan sponsor to levelized pricing. Going back to my initial introduction, the marketplace is getting back to the future, but we're not quite there yet. So there's a lot of iterations and a lot of things a plan sponsor has to examine before they get to really a true levelized pricing scenario within their plan. First is the type of service contract and fee arrangement they have with their provider. There's really three major types of or service contracts or fee models we see out there in the marketplace. The first is what we call a bundled or asset-based model. This is really the traditional model where it's kind of the free 401k plan paradigm that I talked about. But essentially, a record keeper would say, here's our services, here are the funds available on our platform. Don't pay us a hard dollar fee. There's revenue sharing built into the funds that offset our fee in a bundle. So what happens in the bundled environment is there's no revenue requirement articulated in the service contract. The vendor says, I'll take the risk. Based on your plan size, we'll create a fund menu for you. You'll generate revenue. As the market goes up or the assets in the plan go up, so will the revenues to the record keeper. If assets in the plan go down, the revenues to the record keeper go down as well. And over time, any, quote, excess revenue is kept by the record keeper. So there's no recapture of, quote, excess revenue. The second model, and it's a model that's it's really becoming the model in the larger to mid-sized plan market, and I would even say down to the smaller plan market. I think we're going to see it more and more replacing the bundle model going forward, is the fixed basis point model that we really have been talking about during this presentation. That is where you negotiate with the record keeper a specific basis point revenue requirement, whether it's 5 or 10 or 15 or 20, and that is the total amount of revenue the record keeper will receive to service the account. And that can be offset through revenue sharing or paid directly by the plan sponsor or directly deducted from participant accounts. In this case, the plan's taking a little bit more risk. If the revenue that the funds throw off don't meet that revenue requirement, somebody's going to pay. On the other side, if there's a surplus in revenue above the revenue requirement, now you've got money to reallocate back to participants, whether it's in a levelized or unlevelized environment. The third model is just a fixed dollar model, and we're starting to see this more and more in larger plans, or plans where participants have a relatively large average account balance. Very common to see a fee negotiated that rather than 8 basis points on assets or 10, it's a flat $90 a head paid to the record keeper. Of course, that introduces its own kind of paradigm of excess versus deficit in terms of how much revenue you have to pay that, but it's another type of fee model that's out there in the marketplace. So you really need to determine for your client which model are they in before you start talking about fee levelization. The one you have to eliminate is the first one. The bundled model won't work in fee levelization because the record keeper is retaining all excess revenue. You're not recapturing any of that. So you really need to negotiate with your record keeper a specific basis point model or a fixed dollar model to implement levelized pricing. So let's assume your plans are in one of those last two service models or contract models. What's the next step? Well, there's lots of ways of implementing fee levelization out there in the marketplace today. There's not one size fits all, and all record keepers are not equal in what they can deliver on this concept. The first one I want to talk about is, and the one I hear most often when I have discussions with plan fiduciaries or attorneys or other people in the business, once they kind of understand this whole revenue sharing game that's evolved in the marketplace since the early 1990s, is let's just get rid of it. Let's just go to institutional share classes. Let's go to zero revenue sharing funds, negotiate a fee with our vendor, just deduct that fee from the participants or write a check for it at the plan sponsor level, and be done with this game altogether. Well, that would be great, but you can't quite get there for a couple of reasons. At least you can't quite get there today. One reason is you have what we call expense ratio efficiency issues when you try to do that. And this box down below tries to demonstrate that fact. So in this case, let's say you say, well, we're just going to go to the, one of our funds in the plan is Metropolitan West Total Return Bond Fund. And they have, 3 share classes we can choose from: the M share class, the I share class, and the plan share class. And if you just look at the expense ratio, the cheapest expense ratio is the plan share class at 39 basis points versus the M share at 69. So if you're going to a, pure institutional model, you go to the cheapest one, you buy the MetWest Total Return Bond Plan. However, if you look to the right, you can see a part of the problem with that. The plan share class is what we call not efficient. So the M share class, 69 basis point expense ratio, revenue sharing that is thrown off by the fund is 35 basis points. So the net fee is 34 basis points. We call the net investment management of fund expense after we recapture the revenue sharing. You see the I share class throws off, it starts with 44, it throws off 10, it's got the same net fee. Both are efficient, so that works. But now we go to the plan share class, and you can see the expense ratio is 39. It throws off 0 revenue sharing, so the net expense is 39. So a plan that just blindly goes to the MetWest Total Return Bond Fund Plan Share Class pays the lowest overall expense ratio ends up actually paying 5 basis points more for investment management. Again, this is assuming we're doing fee levelization and participants would get the full benefit of any revenue sharing thrown off by the plan share class. And this is just one example. You almost have to examine each mutual fund and its different share classes to determine whether a share class is efficient to move to the cheapest or zero rev share version of it. Second thing to consider is not all funds have zero revenue sharing options. So if you're a plan sponsor and you say, we're just going to use all zero rev share funds out there and ignore everything else, I think that's an issue. There certainly could be some excellent funds or fund managers that you've simply eliminated from your investment selection process as a result. De-levelizing allows you to use funds that may not have a zero rev share class, recapture the excess and levelize everything so you haven't shut out a part of the marketplace to your plan participants. The last thing I didn't put on this slide, but something to consider as well, if you happen to be in a proprietary mutual fund, so you have probably the best example of this is Vanguard. So if you happen to have a plan that's record kept by Vanguard and is using Vanguard funds. So if you know anything about Vanguard, all their funds share essentially zero revenue. That's the way that they're set up. However, if you happen to be on a Vanguard record-keeping platform, while the fund has no explicit revenue sharing built into its expense ratios, they do recognize a small amount of revenue to offset their revenue requirement if you use proprietary funds. So you actually do get a credit for using proprietary funds that you might not get on another platform. Fidelity does the same thing. T. Rowe Price does the same thing. Most other major record keepers that are also investment managers have the same kind of proprietary credit built in on top of explicit revenue sharing payments that fund might make. So, long story short, going to all institutional share classes or the cheapest one available may not get you the best deal possible out there. It really needs to be analyzed on a case-by-case basis. Next, once you've done that and you've kind of sold yourself on fee levelization, you go back to the record keeper and say, how are we going to make these credits? Well, a very common way, though not necessarily the best way, is that the record keeper says, well, at the end of each quarter, we'll look at where all the participant balances are by fund. And essentially, if you're in a fund that pays revenue sharing, we will make an adjustment. Given that participant a credit above the revenue requirement. If you're in a fund that pays none, you will get a debit based on your quarter-end balance. It gets you to fee levelization, but there's definitely potential problems with that system. And the big one is that the potential to game the system. So if you think about it, if it's only a snapshot at the end of each quarter, I'm a participant, I own the Vanguard S&P 500 index fund, it shares no revenue. I own it for 2 months and 29 days. On the next day, I move it to the American Funds R4 share class that shares 35. So at the end of the quarter, it looks like I'm entirely invested in a fund that pays 35 basis points. Guess what? When you use this quarter-end balance system, that participant gets a 35 basis point credit, or whatever the difference between the revenue requirement and the revenue sharing was for that quarter. So not that participants would spend a lot of time thinking about or doing that, but there's definitely ways to game the system. The reverse is also true as well. If I was in a revenue sharing fund for most of the quarter and I happen to move to the non-revenue sharing fund at the end of the quarter, I will have left my money behind. So decent system, but not perfect. Third way we see record keepers helping plan sponsors solve for this levelized pricing model is through unitization or the use of commingled funds. Where basically you're saying, hey, we're not just going to do share accounting and use the mutual fund's NAV. We're going to create our own NAV, build into it the revenue requirement for the record keeper, and all revenue sharing payments get deposited to that and added to the NAV of the fund on a daily or quarterly basis. That's a decent system, but it does create its own issues, primarily at the participant communication end. Now they don't own the exact number of shares in the fund that they would own otherwise. You have to have custom fact sheets. Because you created your own product, you don't necessarily have the same track record to track back to if you own the fund, the actual fund at its own share price. And you might end up in a less transparent system as a result of that. So you do see some of that, but it's in the mid to small market, not necessarily the best example. I think the mega market probably can deal with this better than the small or mid-sized market in terms of using unitization and commingled to solve for this dilemma. Fourth way is average daily balance. Probably a really good method. It tends to, it gets rid of the potential for the quarter imbalance gaming scenario that I talked about. But basically what the record keeper will do is look at everybody's average balance by fund during the quarter. So if I only own the fund for 3 days, I would get a reallocation based on just those 3 days, or the average amount of money I had in the fund over the course of the 90-day quarter as an example. So it's a good system, but not quite exact, but it's certainly better, I would think, than the top 3 if it was an option for your plan and your service provider to implement. Lastly is the daily accrual method. It's where the record keeper actually is keeping track of revenue sharing on a daily accrual basis. So, so looking at my dollars or my shares on a daily basis, it's accruing either a debit or credit to that daily basis, and that follows me depending on where I might move my funds around during the quarter. And it's the most accurate method out there in the marketplace. Unfortunately, it's the method that is not as widely available than the top 4. Probably the most available method in the marketplace is the quarter imbalance or the average daily balance method in 2 or 4. So that's a recap of the 4 methods. So again, kind of to recap this module, you know, you need to get into the right service contract where you can actually identify a revenue requirement, and then you need to have an in-depth discussion about how to handle fee levelization with your plan sponsor. Certainly, if you're doing an RFP, you're going to want to add these questions to the RFP if you're examining new record keepers in terms of making a move, so you know how sophisticated they might be in helping solve this problem and keeping up with the marketplace. So with that, Chad, I think we have our last poll question.
Yes, that's correct. All right, everybody, so this is going to be the last poll. I'm going to launch it right now. We're going to take 30 seconds again. So essentially, all fee levelization techniques are the same. True or false? 30 seconds starts now. All right, everyone, that's the end of the poll. I'm going to give it back to Chris. Thank you.
Great, Chad. So kind of coming back to where we started from, you know, we talked about kind of the evolution of plan record keeping pricing, you know, what revenue sharing is in a mutual fund and how it varies by fund, the distortions that creates when we look at the participant level, and then the solutions to that and the different solutions the marketplace has driven. So, you know, just in conclusion here, again, as I kind of started with, you know, ERISA says, you know, there's no right answer to this. There's no one answer. There's no regulation. But on top of everything else, fiduciaries have an obligation to ask these questions, look at the method for allocating plan expenses, decide on a method that's best for their plan, and and is in the sole interest of the plan participant. One other anecdote, and then we'll open up the questions broadly to the group here. The DOL is taking this seriously. Over the last, say, 12 to 24 months, random audits of our clients from the DOL, questions that they're asking are zeroing in on share class usage. Very specific questions being asked of the DOL auditors. When they see a plan that's using something other than an institutional share class, they're flat out asking the plan sponsor the question, why? We had one large plan sponsor that went through that process. We had gone through a dedicated, prudent process of selecting a method of allocation, going through the share classes in the plan to make sure that they were efficient, that revenue was being shared equally among the participants. I had a policy around it, and it was exactly what the DOL was looking for. The DOL doesn't pat you on the back when you do it right. They simply don't pursue it because you did something improperly. And really what they were looking for was a process. I'll leave it with that really the most important thing out of this, plan sponsors need to understand this dynamic, they need to examine it, and they need to create a process and document that. So if they should be asked about it either by the courts or by the DOL, they have that in their record. So with that, I'll conclude, and Chad, we can open it up to questions.
All right, everyone. So I have a couple questions already in, but just as a reminder for everyone, we are not going to do audio questions and open it up for everyone. But if you open up the webcast dialog box by clicking the little red arrow, there is an area at the bottom to type in questions, and if anybody has any additional questions, we will get to them in order. So Chris, the first question I have is, what if a plan sponsor is using excess revenues to pay qualified plan expenses, think in an advisor or the 5,500 audit fees? How does fee levelization work then?
Yeah, it's a good question, and again, it is something that you could run into in implementing fee levelization. So going back to my example, where you have a revenue requirement of 5 basis points. So that revenue, that's the revenue requirement that the record keeper is requiring to run the plan. So let's say you've been using excess revenue, or the plan has been using excess revenue to pay other service providers other than the record keeper. So maybe they're using it to pay their auditor. They may be using it to pay their fee-based investment advisor. They may be using it to pay for special communication pieces. Whatever the count is, they're using that extra money to pay other fees. So obviously in the example where you levelize fees, you may wipe, in giving people a credit back, you may wipe out that excess. So what you do, and it's really quite easy, is you just need to make a budget. Let's say part of that budget is, what does the vendor require in fees? Let's say that's, again, 5 basis points. How much do you typically spend in these other areas that you were using revenue sharing to pay for? Some of those arrangements might be hard dollars, others might be as a basis point. You need to estimate that. So let's say those other expenses were 3 basis points. So you've determined that your total fees that are required to run the plan are 8. That's the number that you levelize to. So you don't have to levelize only to the fee negotiated with your record keeper, but if you have other fees that the plan is paying, you simply need to budget, add that to the record keeping fee requirement, and levelize to that.
Okay, thank you, Chris. So I do have a second question up. Has there been any court cases where a plan sponsor was sued for not levelizing fees?
Yeah, so I can't find one yet. There's certainly, if you pour through all the excess fee cases going through the courts today, it's interesting that they haven't picked up on this fact. In fact, I was listening to a recording of a presentation being given by the major law firm that's pursuing these cases, and the individual was kind of going through, the process by what they were talking about, and a person in the audience actually asked this question: what about unlevel sharing of fees? And that attorney really said, well, we really haven't brought that up yet. So haven't seen it in the court cases. Clearly, using the Bill Assistance Bulletin 2003-3 is your major defense if they were ever to come to that. And that means going through a prudent process.
All right, thank you very much. So the next question I have is, how does fee levelizing show up on a participant statement?
Yeah, and that's a really good question, and it's the first thing that's asked when this is presented as a solution to a plan sponsor is, oh no, plan participants didn't know they were paying fees. Now we're going to show to them on the front page. So indeed, that is an employee communication consideration when you move from the old method of using revenue sharing without levelization to levelization. So again, it's going to depend by the solution you choose. Anything other than unitizing the fund is going to show up on participant statements, but it shows up typically as a debit or a credit by fund. So it'll actually show up as a transaction in a participant account, usually identified as a plan credit or plan expense debit, as a line item on a participant statement. Likewise, and this wouldn't be in a participant statement, when you go to fee levelization and you've articulated, whether it's 5 basis points or 8 as the plan expense, it makes the 404A5 disclosure much more explicit. So on 404A5, the participant fee disclosure, it will actually say, here's the amount of fees that you will pay during the year for record keeping and other services. And would be that exact amount that you're levelizing to. So it really makes 404A5 much more transparent than it is today if you're in a non-levelized fee relationship. And again, plan sponsors tend to get a little bit nervous about that. In real life, when it's been implemented, there actually hasn't been, in my experience with clients that have implemented, any big backlash among participants. And generally, once they feel that they're being told the truth and it's transparent, they tend to embrace it.
Great, thank you, Chris. So I have a couple more questions. The next one is there a reason why the record keepers aren't simply charging a flat dollar fee to participants? It seems odd that they've been charging it in a roundabout way through the mutual funds offered.
Yeah, I mean, that's a good question. I think it goes back to just the full evolution of how the 401k marketplace has grown up since, the old days when it was all kind of hard dollar charges. I think, at the end of the day, it became an easier discussion with record keepers to say that, all fees are buried in the expense ratio. Just look at the total cost of the plan as part of their offering. So, I just think it was an easier conversation to have with plan sponsors. So, I definitely agree with the spirit of the comment, but I think it's just the way the marketplace has evolved. Clearly, the marketplace is changing. It's going back to that paradigm, whether that's been driven by regulation or litigation or further evolution in technology. That's clearly we're going back to really, I think, is the most practical method of doing that.
Perfect. So the last question I have is the DOL only interested in ERISA plans at this point?
Okay, so as opposed to non-ERISA 403Bs or governmental plans called 457 plans, I'm assuming that's the thrust of the question. Well, the DOL, the DOL's jurisdiction is over ERISA plans, for sure. So the focus of this was on ERISA plans. As far as the 457 market goes, in the governmental space, they're not ERISA governed plans. If it happens to be a jurisdiction in California, if you kind of read through the California Constitution, they refer to ERISA and generally give guidance to folks that are running pension systems at the local level that they should follow ERISA guidelines, but there's not necessarily a direct line mandate to do that. So the DOL is really going to be focusing on ERISA plans today.
All right, also, that was the last question. Again, we want to thank you all for joining and hope you found the webcast today very useful and the information useful today. A couple of housekeeping reminders for those CPAs looking for CPE credits. Please email me, Chad Narani, requesting a certificate of completion. We do have several people that are not looking for CPE credits that are just here for information. In that, please include your full name, license number, and employer information. There is a handout if you look at the webcast dialog box so that you can download it that includes this information as well. For those of you that wish to share the content from this presentation, we will have a recording available on our website in the next few days. And if you would like a soft copy of the presentation, again, email me, Chad Narani, and I will send you over a soft copy version. This has barely scratched the surface of fee levelization as a topic, which is a really new concept in the marketplace. So for a more complex review, reach out to either Chris or I, and we definitely can make some time to sit down with you or your team, colleagues, to review a few other concepts and whatnot and how it really works within specific record keepers if you have additional questions. But for now, this concludes Plan Fee Levelization, going back to the future. Thank you all for joining again. Have a great day, and we look forward to talking with you soon.